Right now, as you watch this, there is a $930 billion wall of debt hurtling toward the commercial real estate market in 2026. And what most people do not realize is that Wall Street has already quietly positioned itself on the right side of this trade, while retail investors and regional bank depositors sit completely blind to the mechanism that is about to break. So I spent the last 72 hours pulling filings, tracking maturity schedules, and mapping out exactly who gets crushed first. And I uncovered 3 things that changed everything I thought I knew about this cycle. The first question that nobody in financial media is asking is this: who actually benefits when $1 trillion of commercial real estate debt fails to refinance? Because someone always benefits from a repricing event, and it is not who you think. The second question is even more troubling. What is the real trigger here? Because the headlines blame interest rates, but the data shows something else entirely. A trigger that has been building for 4 years and is about to hit critical mass in the next 12 months. The third question is the one that separates the informed investor from everyone else. What is the single hidden metric that institutional money is watching right now to time their entry into the wreckage? And that metric is not default rates, it is not vacancy rates, and it is not what anyone on financial television is talking about. I am going to reveal all 3 answers by the end of this video, but I have to warn you. Once you understand the mechanism, you cannot unsee it. So let us start at the beginning, because you cannot understand who gets crushed unless you understand how we got here. And this goes back to a decision made in 2020 and 2021, when interest rates hit effectively zero, and corporate America did something that seemed genius at the time. They refinanced everything. They locked in rates that seemed impossibly low at 2.5%, 3.5%, and they pushed out their maturities 5 years, sometimes 7 years, thinking rates would stay low forever, or at least long enough for them to figure out their next move. It seemed like a masterstroke at the time. Who would not want to lock in the lowest borrowing costs in 4,000 years of recorded financial history? But here is the part of the story that does not make it into the headlines. Those same loans that were refinanced in 2020 and 2021 are now hitting their maturity dates, and the math has completely changed. Because a loan that was originated at 3.8% interest now needs to be refinanced at 6.2%. And when you run the numbers on a $400 million office building in downtown Los Angeles or a $500 million multifamily complex in Houston, that interest rate gap represents the difference between making your payments and handing the keys back to the lender. Let me put this in concrete terms so you understand exactly what property owners are facing. Imagine you own an office tower that you financed in 2021 with a $400 million loan at 3.8%. Your annual interest payment is $15.2 million. Now that loan matures and you need to refinance at 6.2%. Your new annual interest payment is $24.8 million. That is an increase of $9.6 million per year. And here's the problem. Your net operating income has not increased. In fact, if you are like most office building owners, your net operating income has actually decreased because your vacancy rate went from 12% to 25% as tenants downsized or left entirely. So you have higher debt service costs and lower income at the same time. And that math simply does not work. This is not a hypothetical scenario. It is already happening right now. The CMBS delinquency rate for Office Point 1 properties hit 11.8% in October of 2025. That is not a typo. 11.8%, which is higher than the peak of the financial crisis in 2008 and 9, when the office market collapsed. We are already past that level, and we have not even hit the 2026 maturity wall yet. Let me repeat that because it is crucial for understanding what is coming. The office CMBS delinquency rate today is already worse than the worst point of the financial crisis, and the actual wall of maturities does not hit until next year. So what happens when $930 billion of debt comes due in an environment where refinancing is already breaking down? That is the question. I spent 72 hours researching, And the answer is more troubling than I expected. So if that first door I mentioned is about who benefits, let me give you a clue before I explain the full picture. Because there is a group of investors who have been raising capital specifically to buy distressed assets, and they have been waiting patiently for the past 2 years while extend and pretend strategies delayed the inevitable reckoning. Private credit funds and distressed debt specialists have raised over $137 billion since 2020 through more than 430 closed-end debt funds, according to JLL. And that capital has been sitting patiently earning modest returns, waiting for the moment when forced selling begins. But now something has changed. And if you stick with me through this investigation, I will show you exactly what shifted in the last 90 days. That signals the pretending is about to end, and the opportunity window is about to open. Alright, so let me walk you through the 5 pieces of evidence that connect this puzzle. And I want you to think of this like a case file, where each piece of evidence reveals a layer of what is really happening beneath the surface. Evidence. Card number 1 is the headline that everyone knows, but few people truly understand. $930 billion in commercial real estate loans mature in 2026. According to MSCI, that is more than triple the $300 billion that matured in the second half of 2025. And the reason it is so concentrated is because lenders spent 2023 and 2024 extending loans, pushing maturity dates further out, hoping that conditions would improve. But conditions did not improve, they got worse. So all those extended loans are now stacking up in 2026, like rush hour traffic converging on a single-lane highway, and the bottleneck is about to cause a massive collision. But here is what the headline does not tell you. That $930 billion number includes the scheduled maturities, but it does not include the loans that have extension amendments with performance triggers that hit in 2026. Even if the loan technically does not mature until 2027 or 2028. And those triggered extensions could add another $200 billion or more to the effective maturity wall, which means the real number might be closer to $1.1 trillion or $1.2 trillion when you include everything that has to be dealt with next year. This is the first breadcrumb, and it connects directly to the hidden metric I will reveal later. Evidence. Card number 2 is something most people miss entirely, and this is the filing level data that tells the real story. The average interest rate on commercial real estate loans originated in 2025 is 6.24%, but the average rate on the loans that are maturing is 4.76%. That is a gap of nearly 150 basis points, which might not sound like much until you do the math on hundreds of billions of dollars. At 150 basis points, higher interest on a $500 billion loan portfolio, that is $7.5 billion in additional annual interest expense. That has to come from somewhere, either from higher rents, which are not happening in most markets, or from lower operating costs, which have already been cut to the bone, or from additional equity injections from sponsors who may or may not have the capital to contribute. And when you apply that to the full $930 billion coming due, it means borrowers are facing a collective refinancing cost increase that many simply cannot afford, even if their properties are performing perfectly. Let me explain this in a way you can understand in 30 seconds. Think of it like buying a car with a loan at 4%. And 5 years later, your credit is the same, your income is the same, but the bank says the new loan will be at 6.5%. You might still be able to afford it, but if your income also dropped by 15%, which is what happened to many commercial property net operating incomes due to higher vacancy rates and flat rent growth, then you cannot afford it. And that is exactly where we are now. Property income has dropped, refinancing costs have spiked, and the gap between the two is simply too large to bridge for a significant portion of the market. Here's where evidence card number 3 gets interesting. And this connects back to door 2, the real trigger. The special servicing rate for office CMBS has been climbing steadily, but something changed in the last quarter. The rate of transfer to special servicing accelerated, and the reason has nothing to do with interest rates. It has to do with the occupancy cliff that hit the office market in 2024 and is now flowing through to 2025 financials. Let me explain what I mean by the occupancy cliff, because this is crucial for understanding timing in the commercial real estate world. When a tenant decides not to renew their lease, the landlord does not immediately feel the financial impact. First, there is usually a notice period. Then, there is the actual move-out. Then there is the period when the space sits vacant. Then there is the lease-up process for a new tenant, which can take 18 months or more in a weak market. And only after all of that does the reduced occupancy fully show up in the financial statements that lenders review when making refinancing decisions. So the vacancy rate goes up, but the impact on debt service coverage ratios does not show up immediately. It shows up 12 to 18 months later when the financial statements catch up to the physical reality. And that lag time is exactly what we are seeing now. Office vacancy rates nationally hit 19.9% earlier this year, up 170 basis points from the prior year. But the CMBS delinquency data we are seeing now reflects properties whose tenants left in late 2023 and 2024. So the properties that lost tenants in 2024 will show up as delinquencies in late 2025 and 2026, which means the wave we are seeing now is just the leading edge of a much larger surge that will hit over the next 12 to 18 months. This timing mismatch is one of the reasons the market has not fully priced in the distress that is coming, and it is one of the key insights that institutional investors understand, but retail investors typically miss. All right, I want to pause here for a second because if you are finding this level of detail valuable, there is more coming. But I only create this depth of research for subscribers who actually want to understand the mechanisms behind market moves, not just react to headlines. So if you want to stay ahead of the 2026 story as it unfolds, consider hitting subscribe, because I'm going to be tracking these maturity schedules and delinquency rates and special servicing transfers every single week through the critical period. Now, let me continue with evidence card number 4, because this one is about who is actually holding the bag when this breaks. When most people hear commercial real estate distress, they think about the biggest banks like JP Morgan or Bank of America or Wells Fargo. But those banks have relatively low exposure to commercial real estate as a percentage of their total assets, and their diversified portfolios provide substantial cushion even if CRE losses spike. The real exposure is concentrated in regional banks, where CRE loans can represent 300, 400, even 500% of their equity capital. And that level of concentration means a severe CRE downturn could threaten the bank itself, not just dent its earnings. According to Florida Atlantic University's Banking Initiative, which tracks CRE exposure across the largest banks in America, 59 of the 158 largest banks have CRE exposure exceeding 300% of their total equity capital, which is the threshold that federal regulators consider excessive and a warning sign for potential instability. Let me give you some specific numbers so you understand the scale of the concentration. One bank, Dime Community Bank, had exposure of 602%, meaning their CRE loans are 6 times their equity. Valley National Bank sits at 475%. Flagstar Bank, which is part of New York Community Bank Corp., was at 477% earlier this year. And these are not small, obscure banks. These are significant regional institutions with tens of billions in assets and hundreds of thousands of depositors. Compare this to the largest banks. JP Morgan has CRE exposure of about 61% of Tier 1 capital. Bank of America is similar. The diversification of large banks means CRE stress affects their earnings, but does not threaten their survival. The concentration at regional banks means CRE stress could be existential for some of them. Now here's the part that connects back to door 1. Who benefits when these regional banks come under provided pressure? They become forced sellers of their loan portfolios. And when you are a forced seller, you do not get fair market value. You sell at whatever the distressed debt funds are willing to pay. And the distressed debt funds have been raising capital for exactly this moment. Ares Management, Apollo Global Capital, Blackstone, Brookfield, Oaktree Capital, and dozens of smaller specialized funds have been waiting patiently for the moment when forced selling begins, because that is when the best opportunities emerge. You can buy performing loans, at a discount because the seller is motivated. You can buy subperforming loans and work them out for a profit. You can take ownership of properties through foreclosure at a fraction of replacement cost. And the distress funds have been raising capital specifically for 2026 because they see what is coming and they want to be ready to deploy billions of dollars when the sellers become desperate. Evidence card number 5 is the one that ties everything together. And this is where we start to see the hidden metric that smart money is watching. Let me explain why extend and pretend is ending, and it has nothing to do with lender patience. It has to do with a regulatory and accounting change that most people have not even heard about. For the past 3 years, banks have been employing a strategy called extend and pretend, which works like this. A borrower cannot pay off their loan at maturity, but they are still current on interest payments. The bank knows that if they force a foreclosure, they will take a huge loss because property values have dropped. So instead, they extend the loan by 1, 2, 3 years, hoping that rates will come down or property values will recover, or they can find a way to exit the position without taking the full loss. This strategy has been remarkably successful at preventing a wave of defaults in foreclosures over the past 3 years. But it has a cost. The problem, loans pile up on bank balance sheets. They continue to require reserves and monitoring and capital allocation, and they create uncertainty for regulators, investors, and depositors about the true health of the bank. Now, starting potentially as soon as the fourth quarter of 2025, banks will be able to modify loans and have those modified loans fall off their delinquency reporting requirements after just 1 year. Under previous rules, modified troubled loans had to be tracked and disclosed for a longer period, which created ongoing regulatory and reputational costs for banks. This sounds like good news because it means banks can hide problem loans more easily. But here is the paradox, and this is crucial for understanding the timing. This change is actually accelerating the end of extend and pretend. Because if banks know they can move these loans off their books cleanly after modification, they are more willing to force a resolution now rather than extend again. In other words, the regulatory change that was designed to give banks more flexibility is actually giving them more incentive to deal with problem loans rather than just pushing them out. And the distressed debt funds know this, which is why they are positioning aggressively into 2026. They understand that the pretending is ending and the forced resolution phase is beginning. All right, before I reveal the master key, I want to ask you something, because I am genuinely curious about what this audience is focused on in the comments below. Give me 2 words. The sector you think gets crushed first. Office, multifamily, retail, or something else. And one reason why, for example, you might type office, vacancy, or multifamily oversupply, or retail bankruptcies. Just 2 words and one reason, because I track what my audience is watching and it helps me prioritize what to investigate next. Now let me acknowledge something important, because intellectual honesty requires presenting the strongest counterargument to any thesis. There is a strong counterargument to the crash scenario, and I want to be transparent about it, because if you only hear one side of a story, you cannot make informed decisions. The counter-argument goes like this. Interest rates have come down. The Fed has cut by 100 basis points since September 2024. And futures markets are pricing in additional cuts in 2025, which means refinancing conditions are improving, not worsening. The 10-year Treasury yield, while volatile, has moderated from its highs above 5%. And mortgage rates for commercial properties have started to decline. Credit spreads, while elevated, have not blown out to crisis levels. The high-yield bond spread is around 280 basis points, which is tight by historical standards, and does not suggest imminent widespread distress. Furthermore, the maturity wall has been pushed out multiple times since Moody's first coined the term in 2010. There was supposed to be a crisis in 2012. Then 2014, then 2018, then 2024, and each time the wall was pushed out, refinancing happened, and the predicted crisis never materialized. So why should 2026 be different than every other year, when the maturity wall was supposed to cause a crisis, but never did? That is a fair and legitimate objection, and I take it seriously. Here is why I think 2026 is actually different this time, and why that objection, when you examine it carefully, actually becomes a clue rather than a rebuttal. In previous cycles, when the maturity wall approached, the Fed responded to signs of financial stress by cutting rates aggressively and keeping them low for extended periods. Companies could refinance at similar or lower rates and push the problem out again. The penalty for extend and pretend was low because rates were going down, not up. But in this cycle, two fundamental things are different. First, inflation remains sticky above target. The consumer price index is still running above 3%, and the Fed has signaled fewer cuts in 2025 than the market initially expected. Powell himself said at the December meeting that they still have some work to do, which is Fed speak for do not expect rates to fall back to zero anytime soon. So the assumption that rates will bail out over-leveraged borrowers is much weaker than it was in previous cycles. Second, and this is the crucial structural point, the office market is experiencing a secular shift, not a cyclical one. A cyclical downturn means demand falls during a recession and recovers when the economy improves. A secular shift means the fundamental relationship between supply and demand has permanently changed due to technology or demographics or business model innovation. The work-from-home trend that accelerated during the pandemic has not reversed, and in many ways, it continues to expand. Companies are still reducing their office footprint with every lease renewal, not because the economy is weak, but because they have discovered they can operate effectively with less space. The return-to-office mandates that were supposed to bring workers back have largely stalled. And even where they have been implemented, occupancy rates have only partially recovered. And unlike in 2008, when the office problem was financial and could be solved with monetary policy, the problem now is structural. There is simply too much office space for the current level of demand, and no amount of interest rate cuts will change that equation. You cannot cut rates low enough to make a 50% vacant office building profitable. You cannot cut rates low enough to make a tenant who discovered remote work suddenly want twice as much space. The supply-demand imbalance has to be resolved through conversion, demolition, or price discovery. And that process takes years and involves significant losses for current owners and lenders. So the objection that rates will come down and save the market misses the real trigger, which goes back to door 2. The trigger is not interest rates. The trigger is the fundamental mismatch between supply and demand in the office sector, combined with the concentration of maturities in a single year, combined with the performance triggers embedded in all the extension amendments that were granted in 2023 and 2024, that brings us to the sectors that get hit first, because not all commercial real estate is created equal, and the opportunity and risk are very different depending on where you look. The office sector is the obvious victim, with delinquency rates already at record highs and vacancy rates near 20% nationally. Older Class B and Class C office buildings are getting crushed by a flight to quality as tenants take advantage of high vacancy rates to upgrade to newer, fancier buildings while downsizing their total footprint. The newest and highest quality office buildings are still doing relatively well because they can attract tenants from older buildings, but that just accelerates the death spiral for everything else. I have seen office buildings in San Francisco sell for 60, 70, even 80% below their pre-pandemic valuations, and that is not the bottom. That is just where we are now, with significant additional distress still to come. But here's something most analysts are missing, and this is important because it affects a much broader group of investors. The multifamily sector is following the same trajectory, just 12 to 18 months behind. Multifamily CMBS delinquencies jumped to 7.12% in October 2025, which is the highest level since December 2015, and nearly double where they were just 6 months earlier. The reason is a massive wave of new apartment construction that came online in 2023 and 2024, creating a supply glut in markets like Austin, Phoenix, Dallas, Atlanta, and parts of Florida. At the same time that rent growth has flatlined or gone down. Negative in many of these markets, properties that were underwritten at 5% annual rent growth are now seeing flat or declining rents, while their floating rate debt has reset dramatically higher, which crushes their debt service coverage ratios. The multifamily delinquency rate is accelerating faster than office right now because a lot of multifamily deals were financed with floating rate debt and short-term bridge loans that have already matured or are about to mature, and the borrowers are discovering that the refinancing market is much less accommodating than they expected. MSCI data shows that 60% of the apartment loans that were originated in 2021 and 2022, with maturities in the second half of 2026, and those deals were underwritten at peak valuations with aggressive assumptions about rent growth and cap rate compression that have not materialized. So the multifamily sector, while it does not get as many headlines as office, may actually produce more distressed opportunities in the near term because the timing is more compressed and the financing structures were more aggressive. Retail is a mixed bag. Depending on the specific property type, grocery-anchored neighborhood centers continue to perform reasonably well because grocery shopping has proven resistant to e-commerce disruption. But regional malls and power centers continue to struggle with store closures and declining traffic. And the retail sector has been restructuring for over a decade now. So much of the distress has already been recognized. Industrial and logistics is the bright spot, with vacancy rates still low and demand driven by e-commerce growth and supply chain reshoring. But even here, there are pockets of stress in markets that were overbuilt during the pandemic logistics boom when everyone thought online shopping would grow forever. And the data center boom continues to attract capital because AI infrastructure demand is insatiable. But that is a very specialized sector with high barriers to entry. Remember door 3, the hidden metric that smart money is watching? Well, here is the reveal. And I want you to pay close attention because this is actionable information that most retail investors never get access to. The metric that matters most is not the headline delinquency rate, because that is a lagging indicator. By the time delinquencies spike, the distress has already been priced into the market, and the best buying opportunities have already been identified by institutional investors. The metric that smart money actually watches is the special servicing transfer rate, specifically for recently originated loans, meaning loans that were made in the last 2 to 3 years at the peak of valuations and aggressive underwriting. When that rate starts spiking, it tells you that even the most recently underwritten deals are struggling, which means conditions have deteriorated beyond what any lender anticipated when they made the loan. And that is when the real forced selling begins, because lenders lose confidence in their ability to distinguish good loans from bad loans and become willing to sell entire portfolios at deep discounts just to get the exposure off their books. The corollary metric is the debt service coverage ratio. For 2021 and 2022, vintage floating rate loans, specifically in the multifamily and office sectors, because those loans were underwritten at peak valuations with aggressive rent growth assumptions and ultra-low rate caps that have now expired. When you look at the most recent data from KBRA's Private Credit Surveillance Report, nearly 30% of the companies with debt maturing before the end of 2026 also have leverage above 10 times EBITDA or negative EBITDA entirely, and have credit assessment scores of CCC plus or below. These are not companies that are going to refinance successfully. These are companies heading toward restructuring, default, or liquidation. And the question is just whether it happens in an orderly way through negotiated workouts or in a disorderly way through bankruptcy and foreclosure. The smart money is watching these specific cohorts, not the aggregate statistics, because the aggregate statistics hide the stress concentrations that create the actual opportunities. All right, let me now bring together all 5 evidence cards and reveal the master key, the single insight that explains why 2026 is the inflection point and what you should actually do with this information. The master key is a concept I call the extend and pretend termination point, and it explains why 2026 is fundamentally different from all the previous maturity walls that were successfully pushed out for the past 15 years. Extend and pretend has been the dominant strategy in commercial real estate lending since the financial crisis. It works like this. A borrower cannot pay off their loan at maturity, but they are still current on interest payments. The lender knows that if they force a foreclosure, they will take a huge loss because property values have dropped since the loan was originated. So instead of forcing a resolution and recognizing the loss, they extend the loan by 1, 2, or 3 years, hoping that rates will come down, or property values will recover, or someone else will take the problem off their hands. This strategy worked beautifully in every previous cycle, because the Fed always came to the rescue with lower rates and more liquidity. Borrowers could refinance at favorable terms. Lenders avoided recognizing losses. Everyone pretended the problem had been solved and moved on. But the termination point for extend and pretend is reached when 3 specific conditions are met simultaneously, and all 3 conditions are now present. First, the gap between old loan rates and new loan rates must be large enough that refinancing fundamentally does not work. Not just marginally not work, but fundamentally not work. We are there.
Average gap is 150 basis points, and that gap makes refinancing mathematically impossible for a significant portion of the market. Second, the underlying property cash flows must have deteriorated to the point where, even at the old interest rate, the loan is marginal. We are there. Office occupancy is down 20, 30, sometimes 50% from underwriting assumptions, and multifamily rent growth has stalled or reversed in many markets. Third, and this is the new factor that distinguishes 2026 from previous cycles, the lenders must face regulatory, accounting, or market pressure that makes extending the loan more painful than resolving it. And we are there. With the new reporting rules that create a clearer path to resolution with regulators getting impatient after 3 years of extend and pretend, with shareholders asking questions about hidden losses, and with distressed debt funds actively soliciting banks to sell their problem loan portfolios at discounts. When all 3 conditions are met simultaneously, which is where we are now, the extend and pretend strategy breaks down because the math does not work. The operating fundamentals do not support the debt, and the incentives for lenders shift from delay to resolution. That is the termination point, and reaching it means the distress that has been building for 3 years will finally flow through to actual resolutions. Whether that is foreclosures, discounted loan sales, property sales at steep discounts, or borrower bankruptcies. Now here's where I want to circle back to something I mentioned very early in this video, a small detail that might have seemed irrelevant at the time, but actually contains the key to understanding the timing of what is about to happen. Remember when I said that loans pushed out from 2023 and 2024 are now stacking up in 2026? Well, here is the part that changes everything about that statement. Those loans that were extended were not just extended randomly, they were extended with very specific amendment terms. And one of those terms, which appears in almost every loan modification I reviewed, requires the borrower to bring additional equity or achieve specific performance metrics by certain dates. If those requirements are not met, the lender has the right to accelerate the loan and demand full repayment. And guess when those trigger dates hit? En masse, in the second half of 2026. So the borrowers who thought they had bought time with their extensions are about to face capital calls and performance tests that most of them cannot meet. And when they cannot meet those requirements, the lenders have contractual grounds to accelerate the loans, which triggers the maturity wall. Even for loans that technically do not mature until 2027 or 2028. This means the actual volume of distressed debt that has to be dealt with in 2026 could be significantly larger than the $930 billion in scheduled maturities, because it includes all the extended loans whose amendment terms will be breached during 2026. I estimate, based on reviewing loan documents and market data, that the effective maturity wall, including triggered extensions, could be 30 to 50% larger than the headline number, which would put it closer to $1.2 trillion that has to be refinanced, restructured, or resolved in a single 12-month period. That level of volume in an environment where refinancing conditions are difficult would overwhelm the market's ability to process it smoothly. And that is when distressed pricing emerges. Because when there are too many sellers and not enough buyers,
prices fall until they reach a level that attracts new capital. So what does all of this mean for you, practically speaking? If you are watching this video, you probably fall into one of three categories, and the implications are different for each. First, you might be a direct investor
In commercial real estate, either as an owner through a syndication or a REIT, or as a lender through a debt fund or private credit allocation, if that is you. The action items are clear and urgent. You need to stress test every property in your portfolio using current refinancing rates, not the rates you hope will exist in 12 months. Assume the worst and plan accordingly. You need to identify which loans in your portfolio have extension amendments with performance triggers and understand exactly what those triggers require and when they hit. You need to have a capital plan for meeting equity call requirements if they arise, or be prepared to walk away and take the loss. And you need to evaluate whether you want to be a buyer of distressed assets or a seller of troubled positions. Because the next 12 to 18 months will offer both opportunities, depending on your risk tolerance and capital availability. Second, you might be a stock market investor with exposure to regional banks or real estate investment trusts, or companies with significant real estate holdings. If that is you, the action items are different but equally important. You should examine your portfolio and identify which regional banks have CRE exposure above the 300% threshold I mentioned earlier. Those banks face disproportionate risk if CRE losses spike, and their stock prices will reflect that risk before the actual losses are recognized. You should understand that even if a bank does not fail, the earnings impact from loan loss provisions, charge-offs, and troubled debt restructurings can significantly impair returns for an extended period. You should look at any REIT exposure and understand which property types and geographic markets that REIT is exposed to, because the performance divergence between sectors is enormous right now and will become even more pronounced in 2026. And you should consider whether your overall portfolio has adequate diversification or whether you are inadvertently concentrated in the sectors and regions that face the greatest pressure. Third, you might be someone who is looking for opportunity in the dislocation and sees the 2026 maturity wall as a potential buying opportunity. And if that is you, the maturity wall does represent exactly the type of event that creates generational buying opportunities. But timing and selectivity matter enormously. If you buy too early, you catch a falling knife and watch your investment decline further as distress deepens. If you wait too long, the best assets are already scooped up by the institutional distressed funds who have more resources and faster execution than individual investors. So what is the signal that tells you when the opportunity window is opening? That brings us full circle to the hidden metric, the special servicing transfer rate for recently originated loans. When that rate accelerates beyond historical norms, it tells you that lenders are losing confidence and becoming willing to sell at discounts. And that is when the opportunity window opens. Right now, the special servicing rate for 2021 and 2022 vintage loans is accelerating. And that acceleration is the early warning signal that the extend and pretend termination point is approaching. But we are not yet at the peak distress moment. The peak will likely come in the second half of 2026, when the confluence of scheduled maturities, triggered extensions, and accumulated stress from the prior 18 months all converge. And that is when the best buying opportunities will emerge. All right, I want to bring this investigation to a close because we have covered substantial ground, and I want to make sure the key insights are absolutely clear. What we are witnessing is not just another maturity wall that will be pushed out and forgotten like the previous ones. This one is genuinely different because of the secular shift in office demand that no amount of rate cuts can reverse, because of the interest rate gap that makes refinancing mathematically impossible for a significant portion of borrowers because of the concentration of maturities and triggered extensions in a single 12-month period, and because of the regulatory and market pressures that are pushing lenders toward resolution rather than continued extension. The beneficiaries of this dislocation will be distressed debt funds and private credit specialists who have been raising capital specifically for this moment. well-capitalized property owners and operators who can acquire assets at discounts and manage them through the transition and volatility. Traders and hedge funds who have positioned for spread widening and regional bank stress through shorts, credit default swaps, and option strategies. The losers will be over-leveraged property owners who cannot meet capital calls or achieve performance requirements. Regional banks with concentrated CRE exposure who will face elevated provisions, potential rating downgrades, and in some cases, existential pressure. Passive investors in commercial real estate through syndications, REITs, and diversified funds who did not understand the specific exposures in their portfolios. And anyone who assumed the extend and pretend strategy would continue indefinitely without recognizing that it has a termination point. The single most important metric to watch is the special servicing transfer rate for recent vintage loans, because when that accelerates, it signals that the pretending is ending and the resolution phase is beginning. And once resolutions start, they tend to accelerate, because each resolution establishes market-clearing prices that inform the next transaction and create a reference point that makes additional resolutions easier to negotiate. If you found value in this investigation and you want to understand how the 2026 story develops over the coming months, I am going to be tracking this every single week. The maturity schedules, the delinquency transfer data, the special servicing transfers, the regional bank earnings calls, the private credit fund announcements, everything that tells us where we are in the cycle and when the opportunity window is opening, because the next 12 months will determine who wins and who loses in the biggest repricing event in commercial real estate since the financial crisis. And I want to make sure my audience has the information they need to be on the right side of that trade. Subscribe if you want to stay informed, because once you understand the map, you cannot unsee it. One final thought before I close, because there is something philosophically interesting about market cycles like this one that relates to human psychology and decision-making. The extend and pretend strategy was not irrational for the lenders who employed it. They were making a calculated bet that conditions would improve, and for many of them, that bet might still pay off. Individual banks with strong capital positions and diversified portfolios may emerge from this cycle in good shape. The problem arises when everyone makes the same bet simultaneously, because when bets are correlated, outcomes become correlated. And when outcomes are correlated, small changes in conditions create cascading effects that would not occur if positions were more distributed across time and circumstance. That is exactly what we are seeing with the 2026 maturity wall. It is not that any individual loan is necessarily bad in isolation. Many of these loans could be fine if they matured in different years, or if only a portion of them needed to be refinanced at once. The problem is that so many of them were extended to the same general time frame that the system is now fragile to any negative shock. Tariff uncertainty that slows economic growth, a geopolitical event that causes risk aversion, sticky inflation that prevents additional Fed cuts. Any of these shocks would be manageable for a system with distributed maturities and diversified exposures. But for a system where $930 billion of debt all needs to be dealt with in a 12-month window, the fragility is extreme, and the potential for cascading effects is high. That fragility is already built into the system, and all we are waiting for is the catalyst to reveal it. So, watch the special servicing data every month. Watch the regional bank earnings calls for commentary on CRE reserves and charge-offs. Watch the private credit fund announcements for signals about deployment, pace, and pricing. Watch the 10-year Treasury yield for any resurgence that would further stress refinancing economics, because those are the signals that will tell you when the termination point has been reached and when the opportunity of a decade is finally at hand. I want to add one more layer to this analysis because it is something that almost never gets discussed in mainstream financial media, but is crucial for understanding the full picture. And that is the role of private credit in masking the true level of distress in the market. Over the past 5 years, private credit has grown explosively as traditional banks pulled back from riskier lending and private debt funds stepped in to fill the gap. According to PitchBook, private credit loan issuance was around $141 billion through October of this year,
with a significant portion going to refinance existing debt from borrowers who could not access traditional bank financing or the public bond markets. This sounds like a solution to the maturity wall problem, and in some cases it is. Private credit can provide bridge financing, working capital, and rescue capital to companies and properties that might otherwise default. But here is the issue with private credit. The transparency is much lower than in the public markets. CMBS delinquencies are tracked and reported monthly by firms like TREP, and the data is available to anyone who wants to see it. But private credit portfolios are much more opaque. The reporting is
Less frequent, less standardized, and less accessible, which means distress in private credit portfolios can build up for quarters or even years before it becomes visible to the broader market. We got a glimpse of this in 2024, when Pluralsight, a tech company backed by private credit, went through one of the first major private credit restructurings, cutting $1.2 billion of debt and handing control to the lenders. It was a warning sign that the private credit boom had funded some deals that were not going to work out. But because it was a private transaction, there was limited public information about the process or the losses involved. Now multiply that by thousands of private credit loans, and you start to understand the uncertainty that is building in the system. The private credit lenders are generally sophisticated investors who can afford to take losses. But the opacity of the market means that when distress eventually surfaces, it can come as a surprise to the broader financial system, which is already dealing with the more visible distress in CMBS and regional bank portfolios. And that brings me to the final point, which is about the interconnections between these different parts of the financial system. The office CMBS delinquencies, the multifamily stress, the regional bank CRE exposure, the private credit opacity. These are not separate problems. They are all manifestations of the same underlying issue, which is that too much capital flowed into commercial real estate during the zero interest rate period, and too much of it was financed with debt structures that depended on conditions that no longer exist. When you have systemic overinvestment in a sector, the workout process is never clean or contained because the losses have to go somewhere. They go to CMBS investors through lower recoveries. They go to regional bank shareholders through lower earnings and potentially dilutive capital raises. They go to private credit funds through lower returns, potential losses. They go to property owners through equity wipes. And the challenge for investors is understanding how these different channels of loss transmission are connected so you can anticipate where the stress will surface next and position accordingly. That is what this investigation has been about. Not just describing the maturity wall, but helping you understand the mechanisms of loss transmission so you can make informed decisions about your own portfolio and positioning as the 2026 story unfolds. All right, this is not financial advice. I am not telling you to buy or sell anything. This is education and pattern recognition. Once you learn to read the signals, you start seeing patterns everywhere, and those patterns are telling a very clear story right now. The 2026 refinancing wall is real. The extend and pretend strategy is reaching its termination point, and the question is not whether there will be casualties, but who those casualties will be and whether you are positioned on the right side of the trade.